Will October ignite the biggest move Ethereum has ever seen? Are we just days away from Ethereum's breakout moment that could redefine this entire crypto cycle? This video is your ultimate guide to Tom Lee's latest analysis and why he believes all hell is about to break loose in crypto. Whether you're an Ethereum holder or a Bitcoin investor, the next few weeks may set the stage for the rest of this cycle. The spotlight is now on Ethereum. For months, Bitcoin has captured headlines with record inflows into ETFs, but Lee argues the real structural change is happening beneath the surface on Ethereum. From Wall Street moving assets on-chain, to stablecoins hitting all-time highs, to AI converging with decentralized finance, the pieces are lining up for an October surge. In this video, I'll break down why Tom Lee thinks Ethereum is living through its own 1971 moment, and by the end you'll see why Ethereum could be the biggest winner of this bull market and why October may be remembered as the month the floodgates finally opened. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin.
And in terms of the macro trade, I want to take us back to 1971 when the dollar went fully synthetic. And what I mean by that is that in 1971, President Nixon ended the convertibility of the dollar to gold. So in other words, the dollar was no longer backed or exchangeable for gold. It was only exchangeable for other dollars. Okay, so what does that mean? Well, that means that in 1971, the dollar became fully synthetic. Now, people in turn went to find a store of value, which was gold. But keep in mind, that really wasn't the only thing that happened in 1971. In 1971, someone had to create a market for the synthetic dollar. Think about that. All of a sudden, we had to make sure people would be willing to use dollars, especially because it was no longer backed by gold. Well, the winner there was Wall Street. And let's see how this move by Wall Street created an innovation boom. In that 15 years after the 1971 moment, Wall Street created many innovative products. It created money market funds, currency futures, debit cards, mortgage-backed securities, currency swaps, interest rate swaps, S&P index futures, zero coupon bonds, CDOs, and even ETFs. All of that happened following the creation of the synthetic dollar. In fact, of the 30 largest companies today, 7 of these are financial institutions. So you could see Wall Street was a huge winner as we created the synthetic dollar.
In order to understand what's about to happen with Ethereum in October, we have to look back at one of the most important financial turning points in modern history. The year was 1971. President Richard Nixon severed the final tie between the United States dollar and gold. That moment is often described as when the dollar went synthetic. From that point on, it was no longer backed by a scarce asset. It was no longer convertible into gold. It was only convertible into more dollars. A currency that had once been tethered to physical scarcity now floated on trust, policy, and financial engineering. At the time, people searched for an alternative store of value, and gold surged as capital rotated into it. But there was something else happening in the shadows. A system had to be built to ensure this synthetic dollar could be used and trusted. That responsibility fell to Wall Street. The following 15 years were an explosion of innovation as Wall Street worked to engineer demand for this new financial order. Money market funds were born, currency futures took off, debit cards became widespread, securitization of mortgages began, swaps, index futures, zero coupon bonds, even early ETFs. All of these came to life as Wall Street manufactured the tools that gave legitimacy and usability to a dollar no longer backed by gold. By the mid-1980s, finance itself had become the backbone of the economy. Out of the 30 largest companies in the United States, 7 were financial institutions, a fact that would have been unthinkable just a generation earlier. The removal of gold backing did not collapse the system, it lit the fuse for Wall Street's greatest boom. Fast forward to today, and we can see the legacy of that moment everywhere. Global debt markets have grown to more than $120 trillion. Derivatives reach into the quadrillions. Every one of these layers was built on top of the synthetic dollar system that began in 1971. And it all shows one thing. Once money goes synthetic, innovation races ahead at breakneck speed. Now comes the key insight from Tom Lee. He sees Ethereum standing at the edge of its own 1971 moment. Just as the dollar went synthetic, Ethereum is about to become the foundation of a synthetic world of digital value. The pattern is almost identical. In 1971, Wall Street had to invent new instruments to make the dollar usable without gold. Today, institutions are preparing to invent new instruments to make Ethereum the backbone of finance. Stablecoins, tokenized assets, new forms of collateral, reputation markets, intellectual property monetization. These are the money market funds and currency futures of the blockchain era. Already, over $160 billion of stablecoins circulate on Ethereum, doubling in just 18 months, and global banks from JP Morgan to Goldman Sachs are actively piloting tokenization projects on the network. As history shows, seismic shifts in money do not just reprice assets, they rewire the entire system. Ethereum's October setup is being framed as that kind of moment. The shift where all hell breaks loose because once traditional finance begins replicating its entire architecture on Ethereum, the floodgates of innovation and liquidity burst open. And that leads directly to the next step. 2025 may mark Ethereum's synthetic transformation, the point where real-world assets begin migrating onto chain and Ethereum becomes the platform for an entirely new era of value.
Well, Ethereum is having this 1971 moment. And what do I mean by that? Well, there's a couple of things that happen. The Genius Act is creating the stage for a stablecoin boom, and I've covered this in the previous video. And SEC's Project Crypto is moving Wall Street onto the blockchain. Wall Street is going to financialize the entire system, the existing system of real-world assets onto the blockchain, but they're also going to create inefficiencies by itself moving their architecture onto the blockchain. So in our view, Ethereum is having its 1971 moment, where the real-world assets are becoming synthetic or tokenized. Treasury Secretary Bessent sees this becoming a multi-trillion-dollar market for stablecoins. And it's not just stablecoins, but banks are already moving to build products on Ethereum, whether it's JP Morgan, Robinhood, Goldman, Bank of New York, even Walmart and Amazon. So what does this mean? Well, in 2025, as the real world becomes digital, it's going to be natural to say, I want to find the digital store value. And that is Bitcoin. And I'm a believer in Bitcoin. But it's also going to create a market for digital assets. And we think the winner there is Ethereum.
Ethereum today is experiencing the kind of turning point that only happens once in a generation. Tom Lee calls it Ethereum's 1971 moment. Back then, the dollar shed its gold backing and a wave of financial innovation followed. Now, the real world is shedding its analog limits and moving into a digital framework with Ethereum positioned as the core settlement layer. Two massive shifts are setting the stage. First, the Genius Act is laying the groundwork for a stable coin boom. Second, the SEC's Project Crypto is pulling Wall Street's machinery onto blockchain rails. These changes are not abstract. They mean banks, brokerages, and asset managers are preparing to replicate and expand their entire playbook inside Ethereum's ecosystem. When assets turn synthetic, liquidity floods in. In the 1970s, Wall Street built money market funds, swaps, and derivatives to stabilize and grow the synthetic dollar. In the 2020s, it will tokenize stocks, real estate, credit, and even intangible capital like intellectual property and reputation. Treasury Secretary Bessent has already outlined a multi-trillion-dollar trajectory for stablecoins, with Ethereum capturing the majority share. The network is proving it. Just in the past week, Ethereum added over $6 billion in new stablecoin supply, more than half of what Solana has managed in 5 years. Ethereum now holds more than $160 billion in circulating stablecoins, double the level of 18 months ago. Those numbers are not projections, they are active flows, and they make Ethereum the financial gravity center of digital money. Look at who is coming on board. JP Morgan, Goldman Sachs, Bank of New York, Robinhood, even retail giants like Walmart and Amazon are testing products and pilots built on Ethereum. This is not a trend confined to crypto natives, it is the largest institutions in the world signaling where their future architecture belongs. As these firms tokenize assets and collateralize activity on Ethereum, they create inefficiencies that invite further innovation. That is how derivatives were born after 1971, and the same cycle is repeating now. Tokenized treasuries, on-chain credit markets, reputation-based lending, monetized royalties. Every corner of finance that Wall Street touched with the synthetic dollar is about to be rebuilt on Ethereum. The conclusion is straightforward. Bitcoin will continue to serve as the ultimate store of value, but the platform where the bulk of this construction happens is Ethereum. Stablecoins alone already validate this, but the bigger picture is about institutional architecture. In the same way Wall Street's tools define the synthetic dollar era, Ethereum's digital rails are about to define the synthetic asset era.
And SharpLink's chairman, Joe Lubin, agrees. He says Wall Street will stake ETH because they currently pay for their infrastructure, and Ethereum will replace much of the many siloed stacks they operate. You can see a lot of this is taking place on Ethereum. And it's not just Wall Street. AI is also building products on the blockchain. In fact, we think one of the big story arcs is that it's not just Wall Street building itself onto the blockchain. It's really AI converging onto Ethereum. One of the co-founders of Ethereum actually said this. He thinks Ethereum could be the key to AI decentralization and actually act as a decentralized partner in solving current problems with AI intelligence platforms. So what does that mean? Well, that means that you're going to monetize data collection, royalties, loyalty programs, verify agentic AI, and proof of humanity. That's also taking place on Ethereum. So you can see the future is quite bright. And that's why, we come back to this analysis by ethdigitaloil.com that Ethereum's productive essentially is the underlying token that's going to power both Wall Street and AI. And keep in mind, as you worry about supply, Ethereum's supply is growing below that of Bitcoin. And we also know as an asset class, if we think of Ethereum as digital oil, well, that's really what markets should be used to. From 1990 to 2018, ExxonMobil was one of the top 5 largest companies in the S&P 500, and it was always valued on a multiple of its price to oil reserves. So let's think about Ethereum's network value in that context. Well, here's Ethereum's price since 2018. And as you can see, there's 2 periods I'm shading here. These are called bases. And in Wyckoff's methodologies, they say the bigger the base, the bigger the breakout.
The signs are piling up. Ethereum is not only becoming Wall Street's chain of choice, it is emerging as the bridge between traditional finance and the most powerful new force in technology, artificial intelligence. Tom Lee has been clear about this convergence. He frames Ethereum as the platform where legacy finance and new compute collide. SharpLink's chairman, Joe Lubin, has already stated that Wall Street will stake Ethereum because it can replace the many siloed infrastructure stacks they currently pay to maintain. The efficiency gains alone make Ethereum too attractive to ignore. But the story goes beyond banks and brokers. Artificial intelligence is converging onto Ethereum, creating the next major arc of digital transformation. Staking is not a theoretical concept, it is the operational backbone of Ethereum's proof-of-stake model, and for institutions it is an irresistible proposition. Tom Lee highlights the dual incentive at work here. Instead of paying ongoing costs to maintain outdated infrastructure, they can stake Ethereum, secure the network, and earn yield in return. This creates a dual incentive, lower operating expenses, and direct financial returns. For Wall Street, that turns Ethereum into both a replacement technology and a revenue-generating asset. When you line this up with trillions of dollars in tokenized assets already on the horizon, the logic becomes unavoidable. Wall Street has every reason to stake Ethereum, and once that movement accelerates, demand for the token itself scales with it. But the other side of this equation may be even bigger. Artificial intelligence platforms are searching for ways to decentralize data, verify agents, and distribute value. One of Ethereum's co-founders has argued that the network could act as a decentralized partner to AI, preventing monopolization by a handful of corporations and unlocking models where data royalties, loyalty programs, and proof of humanity can all be built natively on-chain. Tom Lee points to this as a core pillar of Ethereum's runway. That means AI outputs become monetizable, verifiable, and secure on Ethereum rails. This is not a vague dream. Already, projects are launching to tokenize data streams, create agentic AI identities, and link digital reputation to blockchain settlement. Ethereum is uniquely suited to capture that convergence. The analogy often used is digital oil. From 1990 through 2018, ExxonMobil ranked as one of the 5 largest companies in the S&P 500 because oil underpinned and global growth. Tom Lee applies that same lens to Ethereum. Functioning as the fuel for decentralized computation and settlement, Ethereum holds the same position for digital economies. Its supply is expanding more slowly than Bitcoin's, which means its scarcity is tightening even as demand multiplies from Wall Street and AI. Historical market structures tell us what happens when you build massive bases of accumulation. When the breakout comes, the bigger the base, the bigger the move. Ethereum's price chart since 2018 shows two major bases forming, and technical analysts see the setup aligning for another explosive breakout. Tom Lee returns to this point often, arguing that the structural base supports a powerful next leg. The key transition is this: if Wall Street's future operations and AI's future architecture are both converging on Ethereum, then the narrative of Ethereum as just another altcoin is gone. The next chapter is Ethereum as the foundational infrastructure of the digital economy, powering the two most important shifts of our time. And that sets the stage perfectly for the next discussion, where we look at how breakouts in Ethereum have played out before and what the price targets could be if history repeats.
In 2020, that breakout took place, and Ethereum went from $90 to $48.66, or 54 times increase. Well, the low point here in this base was $13.85. So with this breakout, we're expecting an upside move. Is it potentially 54? I'm not sure, but that's what happened last time. Another way to think about Ethereum is the Ethereum to Bitcoin ratio. And in our view, the tailwinds I'm talking about argue for an all-time high in this ratio. The 8-year average Ethereum to Bitcoin ratio is 0.04790, and it's currently 0.04032, meaning we're below the long-term average. The all-time high in this ratio was 0.080727. Of course, it started off higher, but I'm talking about the 2021 all-time high. So we think that not only should Ethereum recover to the long-term average, it should probably get to the all-time high ratio and arguably exceed it as we start talking about Ethereum acting as the chain for both Wall Street to build its payment rails and the financial system, as well as AI. So let's think about what that means for price. So I have a grid here. On the left side is Bitcoin price levels, and then going across are various levels of the Ethereum to Bitcoin ratio. Our year-end target, this is from the Fundstrat side, for Bitcoin is $250,000. And if you look at the 8-year average, okay, then you can see the range of prices for Ethereum using this ratio and different levels of Bitcoin. And here's the 2021 high. And as you can see, at a $250,000 Bitcoin, you get to somewhere between $12,000 and $22,000 value per Ethereum token. But that's just a ratio recovery. If you look at the replacement cost of payment rails and the banking system, that gets you to an implied value of Ethereum of around 60,000. And that puts the ratio at roughly 0.2500 Ethereum to Bitcoin ratio. And as you can see, that's how you get to $62,000 per Ethereum token. So plenty of upside.
The last time Ethereum broke out of a long consolidation base, it produced one of the most powerful moves in crypto history. In 2020, Ethereum's price launched from $90 to nearly $4,900, a 54 times increase. Tom Lee has pointed to that rally as a model for what happens when fundamentals align with a supply squeeze. That kind of expansion is rare, but it demonstrates the scale of upside possible when demand collides with a tightened supply. Today, Ethereum sits in a similar setup. The most recent base formed with a low of 1,385, and if history is a guide, the bigger the base, the bigger the breakout. The real kicker comes when analysts calculate Ethereum's value based on what it could replace. Tom Lee frames it through the lens of payment rails and banking infrastructure. The cost of building global settlement systems is enormous. If Ethereum becomes the network where those systems migrate, the implied value per token soars. That calculation points to around $60,000 per Ethereum, a level that reflects not only ratio recovery but wholesale replacement of financial architecture. At that point, Ethereum's ratio to Bitcoin lands around 0.25, a figure that would have sounded impossible just a few years ago, but is now entirely plausible given the convergence of catalysts. The technicals, the ratios, and the fundamentals are all lining up. Ethereum has formed a massive base, its ratio to Bitcoin is still below average, and the real-world applications coming online are larger than anything blockchain has tackled before. Tom Lee is clear that if the last breakout delivered 54 times upside, this next one does not need to match it to still transform portfolios and rewrite the financial map. And that brings us to what comes next. October is not just about charts, it is about institutions preparing to act. Technical analysts like Mark Newton are already mapping price levels in the near term, and treasury strategies are becoming the new playbook for Ethereum adoption. That is the lens we step into next.
I also asked Fundstrat's Mark Newton for his technical take on Ethereum, and he thinks Ethereum could reach 9,000 by early January. According to him, Ethereum could reach 9,000 in late January, but he also believes that in September, Ethereum could be set to reach somewhere between 5,500 or so. And now let's turn to digital asset treasury fundamentals. There's 5 ways for a digital asset treasury like Bitmine to increase its Ethereum held per share. It can issue stock at a premium to the dollar held of the ETH per share. It can do equity-linked securities to monetize volatility. It can use income from operations to buy more ETH. It can earn staking rewards and invest more in Ethereum. Or it can acquire digital asset treasuries trading close to NAV. And Ethereum treasury companies are crypto infrastructure businesses. First of all, Ethereum is a proof-of-stake blockchain. So Ethereum treasury companies secure the network. Ethereum generates a staking yield, and that's effectively revenues for Ethereum treasury companies. Staking secures the network. So these treasury companies are providing an important security operation. And eventually stablecoin issuers and real-world assets will want to stake ETH. And again, as Joe Lubin points out, he believes that this is what Wall Street will ultimately do. And here's an example, or I think the best example of a successful crypto treasury is MicroStrategy, which has seen the stock price go from 13 to 335 over the last 5 years. And as you can see, 10 times of the return came from Bitcoin's rise from 11,000 to 108,000, but 25 times of the total return of the stock price from 13 to 335 implies that the treasury function delivered roughly 15 times that return.
Tom Lee has often said that technicals and fundamentals need to be read together, and Ethereum's near-term setup is proving his point. Fundstrat's Mark Newton, one of the leading technical analysts on Lee's team, believes Ethereum could reach $9,000 by early January. His view is that Ethereum is primed to hit the 5,500 range in September before moving toward that 9,000 target into the new year. Those levels are not random guesses. They are rooted in chart structures, momentum indicators, and the same kind of base breakouts that have defined Ethereum's past explosive runs. For Tom Lee, this kind of technical roadmap gives the timing to match his macro thesis. Beyond price levels, Lee points to something even more powerful, the treasury model. The same way MicroStrategy used Bitcoin as its corporate reserve and multiplied shareholder returns, Ethereum treasuries are beginning to emerge as a force of their own. There are 5 ways a digital asset treasury can increase its Ethereum per share. They can issue stock at a premium to the Ethereum value held. They can structure equity-linked securities to monetize volatility. They can funnel operational income into Ethereum purchases. They can earn staking rewards, compounding the treasury's growth, and they can acquire other treasury companies trading close to net asset value. Each of these paths expands the Ethereum base held, which amplifies upside for investors. Tom Lee often points to MicroStrategy as the best precedent. Its stock price climbed from 13 to 335 in 5 years. Roughly 10 times of that return came directly from Bitcoin's rise, but the bigger multiplier, nearly 15 times, came from the treasury strategy itself. By holding, leveraging, and expanding its digital reserves, MicroStrategy outperformed even Bitcoin's gains. Ethereum treasuries can replicate this dynamic. As proof-of-stake networks, they generate yield, secure the system, and build revenue streams directly linked to Ethereum ownership. Over time, stablecoin issuers and institutions managing real-world assets will want to stake Ethereum too, creating a flywheel effect of adoption and reward. For Tom Lee, this is where the story becomes undeniable. The charts suggest Ethereum could reach 9,000 in the coming months. The treasury models suggest Ethereum could multiply far beyond that over the longer horizon. It is the combination of tactical and structural, technical and fundamental. And this is where the narrative closes full circle. If Wall Street is building on Ethereum, if AI is converging on Ethereum, and if treasuries are weaponizing Ethereum as a balance sheet asset, then October may be remembered as the moment the market realized all hell was about to break loose in crypto. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.